All right, welcome everybody to Rolling Trades with RJO Futures. It's June 11th here. Global forces and hard assets. I'm John Caruso, Senior Market Strategist here today. We're going to break down a lot of the macro headwinds and tailwinds that are affecting global markets right now. We've got some specifics we're going to hit on later on in this segment, some charts we're going to break down as well. But first, I wanted to introduce my guest here today, or my co-host, I should say.
Thank you, John.
Alex Turro. He's also a senior market strategist at RJO. Welcome, Alex.
Thank you, John. Appreciate being here.
Alex, why don't you just get into a little bit about what your responsibilities at the firm here are?
Well, I operate my own separate full-service trade desk here at RJ O'Brien, and we're much like John here. We implement a macro overlay where we measure and map rates of change of growth and inflation. So effectively beam counting economic data points as they come in to determine where we are in the sine curve and to determine inflection points in the economy so that us here as commodity traders can get ahead of these inflection points.
That's right.
And in doing so, we can better position ourselves ahead of these larger market moves.
Terrific. That's exactly right. You know, we always want to know where we're at within the broader macro cycle. We want to know where we were, where we're currently at, and where we're eventually trending towards so we can get ahead of some of those key Federal Reserve policy adjustments. So,
right.
All right, kicking off the segment here, we're going to start where I always like to start, and that's, of course, the macro, as Alex just mentioned. We're going to get into U.S. GDP forecast. We're going to take a look at inflation. And lastly, we're going to take a look at the new policy bill, Trump's big, beautiful bill going through the Senate currently right now. But first, we're going to take a look at U.S. GDP. Of course, in Q1, we came out we saw a contraction in the economy in Q1, minus 2.2%. A lot of that was led by the balance between exports and imports. We did see a lot of, we were very heavy on the imports in Q1, light on exports. A lot of that was trying to get ahead of the April 2nd tariff announcements. Now, as we move into Q2, we are seeing the Atlanta Fed GDP forecast come in very robust, a 3.8% reading. That is a slight downgrade from the recent reading of 4.6, but very positive, very robust growth. And conversely to Q1, we're seeing heavy exports right now, and we're light on the imports. So that is certainly affecting U.S. GDP to the positive right now. Consumer spending remains resilient. We did see personal spending up 0.2% in the previous PCE reading. That is a slight revision lower from the previous reading back in April of a positive 0.7. But all in all, very positive. The consumer continues to remain resilient here. We're going to take a look at a chart here because as we move out of Q2, we are expecting a slowdown, another sequential slowdown in growth. So we're currently positive for Q2. We think growth is going to slow as we move into Q3. And a lot of that is coming from some of the sentiment readings that we're receiving. I have University of Michigan consumer sentiment readings up here on the board. As you can see, we're moving from the top left-hand to the bottom right-hand of that screen right now. We actually did see consumer sentiment levels actually reach at one point in Q2 its lowest level since 2008. And I think a lot of that, of course, is being largely affected by tariff policy. There's a lot of unknowns as to what's going to happen as far as inflation is concerned from here. And we certainly are starting to see some households tighten their belts.
Yeah, we'll note, John, on top of that, it is going to be on the back of weakening wage growth as well. So we do have jobs that continue to get revisioned. As we had noticed just last week, we have grown an average of 174,000 in Q1, but with revisions, they only grew by 111,000. So that's a 995,000 K revision in the jobs for the last 2 months. And so this is very difficult to maintain in an income-driven expansion, an economy relative to one that is driven by credit or debt.
Of course. Excellent point there, Alex. And labor, of course, is one of the most lagging economic macro indicators that we have. So when the labor market finally turns over, the signs are already going to be there in growth. We're going to start to see them show up in the earnings reports as well. And usually the last shoe to drop in macro is the labor market. But right now, I've got no real signs of a crack in labor. We did see the JOLTS numbers actually move higher in the last reading. So job openings are still up. So we're just gonna kind of have to wait and see how the cycle treats us from here. Obviously, a lot of questions are going to be answered with tariffs in coming weeks as well. So we're going to see how that moves forward. Taking a look at inflation, we did mention the last time it was on here. I think it was towards the end of May. We have seen a sequential decline in inflation since the start of the year. Now, today, June 11th, we just did receive the most recent reading in CPI, Consumer Price Index. And the last time we were on, we mentioned that last reading of 2.3% was likely the last sequential slide or downgrade in inflation from here. And sure enough, this morning, we get a read of 2.4%. So a slight acceleration. The market was expecting 2.5%. So we did get a slight acceleration. It's almost as if the market's looking at this as a Goldilocks, because it did miss the expectations, but it did increase on a month-over-month basis. So 2.4%, we're starting to see inflation start to creep back in. You take a look at the energy, the price of energies, the price of commodities. We are starting to see things begin to warm back up.
That's right.
Do you agree with that, Alex?
That's correct. It's a broader reflation trade that we're seeing here on the back of this declining U.S. dollar, which is now down over 4% just in the last 3 months, which would be a trending basis. We are seeing a weakening dollar, which in turn is broader reflation, not only of commodities broadly, but U.S. assets. And conversely, on the other side of that, you're seeing it in Europe and also in other equity markets globally, namely Australia, which is a commodity-dependent market environment, which is evidenced by their currency as well, which is continuing to broaden to cycle highs as well.
Yeah, the Australian dollar, that's one we're taking a look at.
Yes, sir.
Yeah, that's largely been historically a commodity currency. So if you take a look at the chart that we have up here, this is the Consumer Price Index. Less food and energy. Obviously, we saw the big spike coming out of 2020 COVID. We saw that actually reach, I think headline CPI was up over 9%, but less food and energy, we were around 6.5%. Now we are retesting that median line down there at 2.5%. And I think that chart is about ready to reaccelerate once again. If you take a look at the left side of that chart, you'll see how sloppy things got in the late 60s through the 70s. That is certainly something that we're not forecasting right now, but that is certainly something that you have to be aware of going forward, especially with the budget deficits that we're running in Washington, D.C. and projected to do so over the course of the next decade. So that's going to bring me to our next piece here. We're going to talk about the big, beautiful bill that's been presented. It was passed in the House by a narrow margin. That is now in the Senate right now. Just to kind of recap that a little bit, President Trump's big, beautiful bill, it's a permanent extension of the tax cuts that were introduced in 2017. No tax on tips, no tax on overtime, increases the SALT tax deduction to $40,000. The border wall and defense funding funds border wall and defense cuts. We see cuts to green energy and tax credits, tougher on Medicaid work requirements, and changes to student aid. This bill is also projected to add $4 trillion to the national debt over the course of the next decade. As you can see up here on the screen, I've got the projected deficits. We've got the baseline without the BBB, and then with the BBB enacted, as you can see with the big, beautiful spending bill enacted, we have we're going to forecast a 7.3% budget deficit in 2025, 7.6 in 26, 8.1 in 28, 8.4 in 30, and 8.6 in 2034. And mind you, that's not even factoring in the possibility of a recession at some point. It's been a while since we've seen the cycle turn over. So, typically when you do see a recession, you see a spike in the unemployment rate. You see naturally a spike in the in deficit spending, and that kind of brings me to the next chart that I have. I'm sorry, Alex.
No, I was just gonna. Yes, I was just gonna note, John. Right now, the recession risk that was pricing in at the beginning of the year, at the onset of these tariffs, has largely is now quelled effectively. With you have the U.S. economy accelerating here into June. You take a look at the rates market. The MOVE index, which is the volatility component of interest rates, has come down considerably just in the last month of over 865, basis points, which equates to minus 8.7%. Spreads are tight, and we continue to move forward.
Yeah. The next chart that I wanted to bring to everyone's attention here. This is actually a pretty terrific chart that I actually. This was presented at the the most recent Bitcoin conference in Las Vegas. It was presented by a macro strategist by the name of Lynn Alden. I follow a lot of her stuff. She's terrific. But she brought this to everyone's attention at the conference. If you take a look at that chart, what it's showing you historically going back to the 60s, the unemployment rate, which is highlighted in red, and how that correlated to deficit spending all the way back to the 60s. And you can pretty much see that unemployment, as unemployment rose, you would see deficit spending rise. It's pretty much the same chart. But if you take a look on the right side that's highlighted in that green box there, sometime around 2018, we started to see that correlation break. And now we're kind of off the rails in terms of deficit spending and debt accumulation. And I just I wanted to show everybody that, because that's where we're at right now. Historically, when you see periods of low unemployment, you see periods of low deficit spending. But now we've shifted paradigms where unemployment remains low and deficit spending continues to remain high. Now, if we do see a period, over the next 1-2 years where the unemployment rate starts to rise again, you're going to see the deficits explode even further, 12%, 13%, 14%. And that's what a lot of these big macro titans, the Ray Dalios of the world, the Paul Tudor Joneses, the Stanley Druckenmillers, are trying to warn a lot of people right now about the possibility of the events of a recession and what that's going to mean for deficit spending from here and ultimately the national debt. So I want to bring that to everyone's attention here. Do you have anything to add on that, Alex?
Well stated, John. No, I think we covered what we needed to say there.
Okay, terrific. So now we're going to jump into the charts here. We're going to talk about a few markets. I think we're going to kick it off with the S&P 500. Alex has a chart up here that he wanted to go through with everyone.
Yeah, so as you can see here, this is just a steep ascending wedge formation pattern. And more so specifically, what I wanted to reference has been the shift in dynamic in the flows. And what we're referring to here are the systematics. So what we're referring to are the CTAs, the risk parity, the vol control funds that are dominating about 90% of the flows in the market today. So these are collectively, they disregard fundamentals and act on, say, for example, something like the volatility scaling, where they look at 1 month realized volatility relative to the 3 month and use that as a barometer based on trend to either build or scale up their exposure or lessen it. So this exemplifies this slow, gradual grind higher that we've been experiencing. And if you take a look at the gamut of these options, you can see coagulation of strikes where the market tends to gravitate towards them and becomes a sort of a magnet. And that's coming ahead into next week's quarterly OPEX, where we have trillions of notional expiring and coming off the board.
And all that happens on massive volume.
That's
massive
correct.
Volume around these strikes.
Yeah. Right. And so right now, there's evidence to suggest that we're still, as the market continues to move higher, volatility continues to dampen, exposure will continue to broaden, and we're seeing right now potentially about 10 billion is going to flow back into the market and create this underlying dampening of, okay, well, we're selling into strength, where market makers and dealers have to sell into strength and buy into weakness, which again continues to consolidate and consequently push the market.
The momentum.
Momentum, right, John.
Yeah. Terrific.
So that was just important to note.
Where do you see stocks headed, obviously, into Q?
Well, like you mentioned, John, with the Goldilocks this morning and the CPI, we did have an initial jump in market price. Notwithstanding, we're now at 61.44 is the all-time closing high. So at this moment in time, we're about 75 basis points away. So I would expect that to more than likely see follow through, because every dip has been being bid up right now.
There's, of course, a few geopolitical risk events that we've got to kind of be aware of. But yeah, absolutely. We've been bullish trend ever since we did see kind of the pullback in tariff policy. I think it was around April 10th here. The market has continued to rally and hasn't looked back. I think a lot of the growth acceleration that we're seeing in GDP, the reacceleration in the inflation trade, I do think a lot of that has been pulled forward, and a lot of it is out of in. So I would be expecting over the course of the next 3 to 6 weeks to see some volatility coming
back into the market, right? Yeah. Especially as we conclude coming into OPEX, where a lot of these levels are going to be, these samples are going to be removed from the calendar, because if we take a look back at Liberation Day, if you will, that's going to be removed here in the coming weeks.
Yeah.
So we shall see.
All right, great. Let's flip over here. We're going to take a look at silver. All right, silver. I was on here a couple weeks ago, and we were talking about the diamond formation that we were in silver. We were largely trapped inside of about a 30-day consolidation period. We put a high probability on the idea that would eventually break out within a couple of weeks, and certainly we have broken out in a big way. Silver cleared that significant resistance area of about 35, and it really hasn't looked back. We're trading 36.40 right now here on June 11th, and I still think we've got some much more price, higher price action to come. We are running a little bit hot right here. It wouldn't surprise me to see us check down to that trend line. You can see that right now. That comes back in around 35. We'll call it 35 to 34.50. But ultimately, my upside targets on this breakout run over the near term are upwards around $38.50 to $39 an ounce.
Right.
And I will also note that after seeing the gold to silver ratio hit that 106 level back in April, we have since dropped to about 91.
Yeah,
that ratio.
Well, after it broke through that, good point, John, on that 97 floor, 97.5. I mean, this is just on the back of strong industrial demand driven by solar, electronics, green technologies. It's interesting to note, John, the May silver deliveries, they had the third highest volume on record.
Wow.
And the second one was in March. And, it's reminiscent. I was thinking of Jesse Livermore here, the stock trader, where he said big money is not in the buying or the selling, but in the waiting. And here we are, John, 13 years later, making yet another high. So
it's been for a long time.
That's right.
I agree. But yeah, this move above 35 and above 36, it is very significant. We know that the Silver Institute's been projected. They've been projecting further supply side deficits in years to come.
Right.
I believe we're on our fourth year now.
Fifth year. We have it here, 118 million ounces, so we're expected to outpace supply for the fifth consecutive year with a deficit of 118 ounces. So yes, this is expected to continue.
Yeah, it's in our eyes, it's a historic breakout here, and I do think we will see silver up into the 40s or the low 40s at some point over the summer. So. All right. We're going to flip over. We're going to take a look at platinum. Similar to silver, another market that is facing severe supply side deficits. This is a market that obviously meandered sideways and chopped around in a range of about 900 to 1100 for a significant period of time. This is a weekly chart that we're staring at right now. And obviously you saw the big move lower, the squeeze down on Liberation Day, April 2nd. And then sure enough, it squeezed a lot of probably smaller players out of that market. We haven't looked back. Silver right now, we're trading over $12.50 an ounce. I believe $12.70. We are a little bit extended up here. It would not shock me to see this market retest the breakout line, hold, and then turn back higher. So another market that's facing severe supply side deficits. You have anything to add on the platform?
Just again, it's not that markets initially move on ratios or valuations per se, but it is interesting to note the gold platinum ratio has gone from 3.6 to 2.75 just in the last 6 weeks. And I'm looked at the next 2021 high of 1337 after it's now gone through the prior highs of the last 3 years, as John had noted.
Yeah, significant breakout there. So I didn't know that. 2021, it was
1337.
1337. There you go, guys. That's probably the next upside target we're going to be looking for in platinum. So let's switch over. We're going to take, lastly, is crude oil. The last time I was on here, I was highlighting that we had an inverted head and shoulders that was lining up. I believe just before I came on, the OPEC had announced another 400,000 in oil output, and then we started to see some grumblings between the U.S. and Iran and the nuclear agreements that they're having trouble putting together. We did note the inverse head and shoulders on that chart. We have since we did highlight 64.20 as a pretty significant level. We have since broken out above that level. So upside targets, we have been recommending to traders to stay long on crude oil. That's been a recommendation. And we've got upside targets upwards around 68 to possibly the low 70s, possibly as high as 71. I do think oil will probably struggle if we get up into that area up there. I know OPEC has threatened with further output hikes. But right now, I think it's pretty clear the problems that we're having as far as getting a nuclear agreement together with Iran. I think that is certainly driving risk. The inflation cycle also driving risk on the upside in price. So you put those two, that geopolitical factor, you plug that in with the cycle, and you've got a pretty good atmosphere for a rally.
And again, noting on the flows, again, John noted that 64.20 level. Once you break out above that, there's the buying, and the machine comes in and starts propagate and push the market higher. And that's constantly what you're seeing here today.
Yeah, absolutely. All right, I think that's going to conclude our episode of Rolling Trades with RJO Futures. Once again, I'm John Caruso.
I'm Alexander Turro.
And if you like some of these insights here, if you want to reach out, I do write a market insight note. I write for the Market Pulse here at RJO Futures. It's a free daily newsletter that we put out. If you want to check out more insights, feel free to email me at jcaruso@rjofutures.com. Best of luck to everybody out there. We'll catch you next time.
Thank you.
The risk of loss in trading futures and/or options is substantial, and each investor and/or trader must consider whether this is a suitable investment. Past performance, whether actual or indicated by simulated historical tests of strategies, is not indicative of future results.